Hello, good morning, everyone. Welcome to our weekly research morning call. So today mainly it's going to be the recap of our US SSP session, which happened last week. We also have air transport and our usual technical analysis and SG Weekly. So before we start, just the usual disclaimer: everything was solely for educational purposes only. So you should seek advice from a financial advisor regarding the suitability of our recommendation. Without further ado, I'll pass the time to Glenn to kick off the US SSP.
Yeah, thanks, Helena. Yeah, so we just start off first with the summary of the US SSP, which we did about a week ago. Yeah, we'll just go through a review of the second quarter market performance. I think it's answering one question, or we're asking one question, is whether or not the AI trade is still paying. I think the short answer is yes, and we will go through on why. And it is only for some of the companies that have the evidence or the proof of that. Yeah. So for the second quarter, what did it tell us? It told us that the fear trades unwound quite fast, right? Anyone who rotated into the gold and commodities after the first quarter, they did miss this second quarter Nasdaq beat. They were up like 26%. So it just proved that staying invested in growth did pay off, eventually. The main driver was that the progress towards the US-Iran ceasefire took the oil down towards $67 and also sent money back into equities, and which is where we saw a rebound. But you have to note that this rally was not evenly spread. You can see that although Nasdaq was up, Max 7 was actually down, by about 11%. And that unevenness is the real story of the quarter. In the next slide, you can see that it's still Max 7 is still the cheapest in over a decade, right? The 23x for PE against the average of around 30x sounds like a bargain. But the main catch that we have is that cheap does not mean that it's an offer. It's really a message that the market is telling us they are discounting the risk that heavy capex will eat into future earnings. So if it's cheap or not, it depends on multiple things. The first thing is that if the monetization, of all this AI capex spend, if it holds, then this multiple will be a discount. But if it does not, that means this 23 times can be quite expensive, right? It can go even lower, right? So that will be the things that we'll be looking at. Next slide. We also always do like a bit of a scoreboard for the second quarter, where we see which AI company did perform well. So in the second quarter, the scoreboard of this did tell us that the market pays the suppliers of AI computes first, right? You're looking at Marvell, AMD, Supermicro, Broadcom. They have collected the capex from whoever ends up winning in AI, and then this is where the market is sort of paying them. And then those platforms that writing those checks to these companies like Alphabet, Apple, Amazon, Microsoft, they did ground out quite solid but very unspectacular gains. And they were only rewarded where the revenue was already visible or where they could prove that they were spending it in the right places. And then at the bottom of the chart here, you can see in red, they have Palantir and Netflix. So this is where the market starts to question monetization, and higher multiple software does tend to derate first. You'll see it later again when Fahmi goes through the software sector. And one thing to note also, if you look at this whole spread here, it's really quite wide, right? It's a 200 percentage point spread between the top performer and then the bottom performer. So it tells us one thing, and the main thing is that you cannot buy AI as a whole or as one basket anymore. And it's a bit of a stock pickers market where you have to choose the right company, right? It's not that every AI will perform well. Every AI company or any company that does AI will perform well. And each of us will also go through which is our topic in terms of the sector. Next slide. Yeah, the next slide, we titled this "The Money is Showing Up," and this is, I guess, the main reason why we are still overweight on the sector. Cloud revenue has hit $92 billion in the first quarter, and it has accelerated for the third straight quarter, up 35%. And this is the fastest that we have seen it, at least for this quarter, in the first quarter since 2021. So it shows that the demand is still ahead of the capacity, and why we are still mainly overweight, right? And it's something that we are checking very closely every quarter, right? Because the day that this cloud growth slows down, but CapEx still rises, it means that the monetization story is not there anymore, and then we will need to look at our recommendations again. Yeah, next slide, we'll be looking at the sector themes. So we'll just go through each of the sectors. We'll start off first with the banks. So banks are on this, I guess, the opposite side, opposing side of the same team. Basically, they don't need to promise anything, right? They are getting higher rates, loans growth, and also this IPO fee wave. That's all paying them today, which is why we titled this "Getting Paid Today." Put quite simply, it just says that the tech writes the checks and then the banks clear them and then they get paid. In the first quarter, next slide. The headline is that the AI boom, the tech boom is really inside the bank's earnings, right? And they do not even need to give $1 of AI capex. Investment banking fees rose by 12 to 28%, mainly from the IPO revival, and EPS, grew by around 15 to 56% across these four biggest banks in America. More importantly, the credit has stayed stable, right? While all of that came through, and the provisions, is pretty flat. In the next slide, we're going through what keeps this banking sector engine going, and that's mainly the Feds, right? They are holding the rates, and the banking system has earned about close to $190 billion worth of net interest income for that quarter, and this is near record levels, and the margins are also pretty relatively stable at 3.3%, right? This is just showing that this is yield without any of the execution risk, and a bit of a mirror image of the tech story that we were telling earlier. So there is one caveat, which is that the tailwind is sort of fading a bit, right? We are seeing that the repricing squeeze is coming back slightly, where asset yields are repricing down faster than the funding repricing, right? So we don't believe that it doesn't really move anything or break our investment thesis. But the thing again, like what I've been saying earlier, is that we have to be very selective within the banks rather than buying just the whole sector. Next slide. So loans growth is still outpacing the GDP growth, and what makes the bank growth different from the tech growth is that they have collateral, right? The loans are growing at around 7.5% against the 5.6% nominal GDP growth, and part of that comes from the banks being there to finance the AI build-out from all these tech companies, right? So they are able to earn from the same AI boom, but without betting the balance sheet on its outcome. And if anything, the AI boom will actually help them lower their OpEx line, by giving more tools to the companies, and yeah, maybe even replacing some headcount or manpower. Next slide. So for my last bank chart, right, we're just seeing that this profitability that the banks are showing is quite structural, right? It's not just benefiting from higher for longer rates, right? We are seeing 56% efficiency ratio with roughly 12% return on earnings. And this is the best cost discipline that we have seen in over a decade. And it sort of survives the rate cuts. It just goes to show the one line, which is getting paid today and provision for tomorrow. And the bank that we are as our pick will be Wells Fargo. We have a buy call with $98 target price, and this is the only bank that we have with a buy recommendation. So why we like Wells Fargo is because it is a self-help story that depends on execution rather than rates, right? So now they are free to grow with their asset cap removed, and they are also more levered for a higher for longer net interest income backdrop. And they are also trading at a discount, more importantly, to JP Morgan and Bank of America. Yeah. So that's our choice, our pick for the US banks. Now moving on to the next theme which I have is the auto, or more specifically will be Tesla, and we have a sell call for Tesla with a target price of $220. And the next two slides I will show you why we believe so. Yeah, so for the first slide, we are seeing some positivity, right? We have to give them some credit, right? Which is where we saw in the second quarter, which they released their deliveries figures about a week or two ago. It was up by 25%, right? This is the best second quarter that they've ever had. And trading volumes are also positive after 7 consecutive quarters of decline. But the main problem that we have with this, and I think the question that we have, is that the volume that is bought with incentives or discounts is not the same thing as the bottom line or the profits. They will be releasing their results, at the end of the month, and that will really prove to us whether or not margins will hold while volumes go up. So it's a bit of like, if volumes go up but margins, decline, then that they're just giving off discounts. But if margins did really hold quite steadily, then I guess there is some positivity for Tesla. Yeah, next slide. Yeah, so another thing that we always watch is the China market share. They did prove that they have managed to sold quite a few number of cars in the second quarter delivery, but I think it's missing the biggest market. The second biggest market, I guess, which is China, and China is the biggest market in the world. So they have sort of missed the growth opportunity there. China's market share is stuck at around 5.6% versus the 7 to 8% that they had 2 years ago. And we thought originally that there will be a consolidation, right, in the EV makers in China. But what we are seeing is that the competition is actually broadening rather than fading. It's because BYD, which is in the red line here, their market share is easing, right? It went down slightly, and it has continued to decline over the last few months. And it just goes to show that a lot of the pricing power and the pricing war is still happening, and it's happening very strongly in China. So without this, China pricing power, right, the margin recovery might have a bit of a ceiling, and I think they will continue to perform a bit more poorly in China as well. So that's all I have for Tesla. I'll now hand it over to Serena for the digital ad section. Thanks.
Thanks, Glenn. Good morning, everyone. I'll be presenting a digital advertising segment in which I title the shift from manual campaign to algorithmic black boxes. So we believe the theme for digital ad segment moving forward will be shifting from a manually configured human targeted campaign into a highly sophisticated automated algorithm engine. So if you look at the photos on the left, you will see on the surface that a consumer is searching for example, like bags and or also like complete the transaction on the laptop. But underneath that, that seamless user experience actually lies on a very massive AI-driven metrics, so that advertisers no longer have to manually select like demographic or test individual creative. And they don't really have to carefully map up the user journey. The entire mechanism will be absorbed by the Gen AI and also machine learning basis. And we think that the modern advertiser, they just have to feed their budgets. They will create the assets by using the company's creative tool, and also conversion go into this platform black box algorithm. For example, like Meta, they have Advantage Plus, and for Google, they have Performance Max. So it will help to predict the intents and to optimize the bid in the milliseconds for advertisers. Next slide, please. Yeah. So the chart on the screen is showing the ARPU growth. At the moment, by looking at the chart, we are still seeing that advertisers still showing a willingness to pay for a premium for precision. We are seeing a double-digit increase in ad pricing. We think it suggests pricing power and advertisers acquisition capabilities by all the media's company. So beginning with the Meta, despite with a very strong base, the ARPU still grow around 28% in the first quarter. More importantly, we see this growth, it wasn't really just driven because they are driven by more ad volume. At the same time, it achieved 12% year-on-year increase in average price per ad. It can suggest that Meta AI model, they are delivering a higher return on ad spend for the advertiser. So it gives them a bigger pricing power. And for Reddit, the ARPU also posted quite significantly at 44% year-on-year growth. At the same time, the company also says that their active advertiser base actually surged 75% year-on-year. we think it could suggest Reddit as a community-driven social media platform. Their data are becoming more valuable because currently the traditional web tracking has been breaking down slowly, and the platform is also showing their capability to attract small to medium advertiser to allocate their budget to the platform. Moving on to the smaller players such as Snapchat, see that the ARPU grew around 7% year-on-year overall. It might seem modest compared to like Meta and Reddit, but the number is showing some regional strength because the ad pricing actually up 48% year-on-year in their core regions such as like Europe, and around like 10% in North America. And we think it also highlights Snapchat. They successfully deploy a direct response ad tech update in the more mature markets, so that they will be able to monetize and sell it more aggressively. As for Pinterest, the ARPU growth 6% overall, but also the same, their core international monetization region are scaling quite efficiently. For example, like in Europe, it's up 20% year-on-year, and the rest of the world also surge around 38% year-on-year as well. Yeah, moving on to the next slide, please. So specifically to the company, for digital ad, we have Meta, in which we title Balancing Liquidity Fear Against AI Profit There. So we see that despite the concern about the increasing in AI spending, because the company capex just for the first quarter of 2026 is growth 45% year-on-year. And then with, of course, majority of the money goes to data center, server, and also network infrastructure. But at the moment, we see the investment case positively because we think the company is building a multiple long-term monetization avenue beyond the core advertising business. So far, we see the capex spending is a strategic investment rather than a purely defensive, like because other AI company are doing so, that's why Meta have to do it. We think that beyond like strengthening the Meta AI infrastructure, they also lay a foundation for new revenue stream, including like AI services, and over the time, a possible cloud or AI infrastructure business that could help to diversify the earnings away from digital advertising. And at the same time, of course, at the moment, have to focus on the ad business as well. But the company also continue to demonstrate the AI investment, enhancing the core business, advertising business, because the revenue growth is around like 33% year-on-year. And we think that this is because of the integration of the recommendation model together with the newly AI model, which is MuseSpark, across the advertising stacks. It comes with a better content relevance, the user engagement, and also ad targeting. That's why, like I mentioned in the ARPU slides, the ad pricing and conversion growth remain pretty resilient. And as for the company will continue to develop AI model. So we think it is the same for every AI model launch. We would think it will take time to reach a certain level of efficiency, like any other LLM deployment. We think there is a typically optimization period during which the model will be refined so that slowly the inference cost will be reduced and monetization capabilities and operating margin should be gradually improved, and it will be becoming more positively correlated as historical charts show. So as Meta continue to roll out the new AI model and application, we do expect the performance to strengthen over the time because of increasing adoption as well. But near-term free cash flow might remain under pressure because of this AI investment, but we think slowly will help to improve the ad efficiency combined with the emerging new AI-driven revenue opportunity. So this is why for Meta, we still have a buy recommendation with the target price of $795. Next slide, please. So next, we have Alphabet, in which we title Return on Compute. And I think for Alphabet now, we are seeing the monetization is still going pretty strong for the ad business after the Gemini integration into search. We think the next focus will be more on the infrastructure level, the power it, because the concerns right now lies on the overcapacity. But at the moment, we currently see a very strong enterprise demand. because of from all the backlog expansion from the hyperscaler. So for example, if you see in the slides, other hyperscalers such as Microsoft and Amazon, their backlog is reaching $627 billion and $364 billion respectively, but it's still coming with a double-digit year-on-year growth. And among them, Google Cloud, even though it's roughly the half of the size of AWS revenue, but we still see a very massive enterprise adoption of Google AI tool is closing the gap, and also the backlog is showing the very fast growth potential. Yeah, and we think the critical details for Alphabet is the near-term revenue visibility, because the management mentions that 50% of the cloud backlog will be scheduled to convert into actual revenue within the next 2 years. We think it will help to provide a very high quality earnings visibility, and at the same time, for the upcoming $1 trillion Anthropic IPO, we think that it can provide Alphabet a balance sheet catalyst as a minority stake owner. But most importantly, we think that it will help to validate the Google Cloud and TPU demand, because Anthropic, they mentioned that their annual run rate has been over $47 billion at the moment. We think they will, after the IPO, they will come up with a massive capex as well. We think a massive portion of that compute budget could flow directly back to Alphabet ecosystem. That's why for Alphabet, we have accumulate rating with the target price of $450. Next slide, please. Turning specifically to Reddit, the growth drivers still center on two things. The first one is performance advertising, and the second one we think will be on data licensing. So for the advertising business, like I mentioned it, the active advertiser grew 75% year-on-year. We think this because it's driven by more adoption to Reddit Max campaign, because Reddit has continued to improve the campaign optimization and AI-driven targeting. That we expect more performance advertiser to allocate budget to a platform. This is because the platform they provide a very high intent community-driven discussion, so that it will be very efficient in ad targeting. But the second thing, and it's more, we think it is more differentiate growth driver, is AI data licensing deal. Because at the moment, LLM training still require very high quality real life human conversation in order to improve the accuracy and relevance of the model. We do expect Reddit to continue to benefit from this trend, because the platform is still one of the most frequently referenced source across AI platforms such as ChatGPT and Google AI Overview. And we think moving forward, the demand for Reddit data should continue to grow as the competition among all the AI developers intensify. So they do have an existing licensing agreement with OpenAI and Alphabet. We do expect it to be expanded, but we also to expect the upside from the potential partnership with other major AI players, including Anthropic and Meta as well, as they continue to aggressively build up their AI model. And we also think having a data licensing deal allow Reddit to utilize their data, but at the same time to maintain a capex-light company. Therefore, we think each data licensing agreement should contribute to support the stronger profitability, and at the same time maintaining Reddit high margin goal as well. As you can see in the chart, that is still maintain over 90% most of the time. So yeah, so that's why for Reddit we have a buy recommendation with a target price of $230. Yeah, and that's all from me. I will pass the time to Helena, I think. Yeah, thanks.
Thank you, Serena. I'll move on to talk about e-commerce. So for e-commerce, the general trend that we're seeing that consumers are more focused on trying to get the best deal essentials. If we take a look at this graph, which is the US retail sales versus the e-commerce year-on-year growth, we can tell that both retail sales and e-commerce are showing slight rebound for the first time in a year. We believe this rebound is driven by two key factors. The first is because inflation has moderated, so that's supporting real purchasing power. And the second, the retailers, they have actually become much more promotional because they start realizing that the consumers, they're increasingly value conscious and responding with deeper discounts and more frequent sales events. It is also interesting to note that actually it's been quite some time that e-commerce continues to grow significantly faster than the overall retail. So that signals that the online channel is still taking shares from the offline retail. So this reflects a very structural change in the consumer behavior. It's supported by the improving delivery efficiency and also the e-commerce expanding into groceries and everyday essential more. As a result, consumers they're becoming increasingly comfortable purchasing categories online that were traditionally bought in physical stores like groceries. Another trend that we realize is the recovery is not very broad-based. Customers, they're highly value conscious. They're focusing on promotions and essential purchases. So to take Amazon's Prime Day 2026 as a good example, their total online spending increased 9.3% year on year, but the average order value actually fell. So that suggests shoppers they're purchasing more, but they're making smaller and more frequent purchases and prioritizing essentials instead of just buying large ticket items. So overall, we think this environment is particularly favorable for big players like Amazon because Amazon has been putting a lot of effort in trying to focus more on lower price and goods, a broader selection of goods, and also faster delivery. So all these are actually very well aligned with today's increasing value conscious customer. But of course, when we talk about Amazon, it's no longer just a retail company anymore. So apart from its continuous strengths in its retail mode, the bigger picture is still AWS and how the growth has been accelerating again. So we look at the chart of AWS growth over the years. It significantly slowed down in 2022 and early 23. This is when enterprise start optimizing their cloud spending. Then growth recovered, but then there was another moderation last year in the first quarter. That was when investors start concerning that AWS might be losing momentum, especially compared to its other cloud competitors. But then the subsequent results have proved otherwise. Growth definitely has reaccelerated. And now with AI becoming a much bigger topic than before, the concerns ease further. We are seeing AWS growing and it's expected to grow at full steam. They're still spending a lot on their CapEx. Now they have a backlog that is up 93% year on year. So it's providing very strong revenue visibility. Then the question that we always get is how are the three cloud players different? So what we think that sets Amazon from the other hyperscalers is that it's not a biased model. So rather than relying on a single AI ecosystem, Amazon has partnered with both OpenAI and Anthropic. So this position itself as a very neutral platform where customers, you can choose the foundation model that best suits you. In contrast to Microsoft, they're still very closely tied to OpenAI. Google, on the other side, is trying to prioritize its Google Gemini ecosystem and then investing in Anthropic. So we believe this more diversified strategy for Amazon, it allows it to capture AI infrastructure demand regardless of ultimately which model gains market leadership. Another strength they have is through their custom silicon. It has now already made Amazon one of the top three data center chip business. Its Trainium chip delivers 30 to 40% better price performance when you compare it to the alternatives, and they are largely sold out across current and next generation capacity. Their Graviton, which is their CPU, is also showing very strong growth. And this business does not just help them gain from their clients, it also helps themselves to save tens of billions of capex annually. So which we view it as a very key differentiator. So overall, we're pretty positive on Amazon. We have accumulated rating with a target price of $280. Moving on to the next sector, which is hardware. So hardware, like last time, we already start showing signs that memory cost is rising. So now we see even more absolute sign that it's rising, and that's causing a lot of the manufacturers to actually increase the price of their product, and that turns away customers and also press on their margins. So while memory inflation, it affects all their smartphone OEMs. The earning impact is a little bit uneven. The impact to lower-end mobile phones is higher due to two reasons. The first is because memory itself takes up a bigger portion of the overall cost of production. And second, because the lower-end phones, they have less pricing power because their target audience are very price conscious. So it's hard for them to pass on the higher cost to their customers. The premium brands with a stronger pricing power and higher end product mix, they're better positioned to absorb and pass through the higher component costs. So if we really look at it company-wise, companies that target mostly to more premium market customers will have stronger pricing power, and companies that has the skill and supply chain advantages should be better positioned to bargain for better cost of production than the smaller competitors. So the benefit companies are probably companies like Apple. So we take a closer look at Apple. This is a chart of the global smartphone market share. Apple's global market share actually peaked at 25% in the last quarter. This is driven by a very strong iPhone 17 launch. However, as we enter into the next quarter, we're seeing the market share moderating back to 21%, allowing Samsung to regain the number one position. So this suggests that Apple's recent strength was largely supported by the launch cycle rather than a structural increase in the market share. We believe the current upgrade cycle is still going really strong, by the way, and they've guided a pretty strong growth for the next quarter as well. But it remains primarily hardware driven. It also benefited from delayed competition from Samsung's Galaxy S26 launch, which is considered a direct competitor to them, and also relatively stable memory costs earlier in the cycle when the prices went up has also supported their demand. They have recently launched new Apple Intelligence, especially the new Smart Siri. It has generated significant interest, but we believe it is still in the prove-it stage. There is very limited evidence right now that these AI features alone are already driving a very material, stronger replacement cycle. At the same time, because of the memory costs, continues to eat into their margins, even though they have stronger pricing power than most competitors. But it's still pressing their margins, and it requires further price increase. They've already increased price for their iPad and MacBook, but if it keeps going on, they will have no choice but to increase the price for their iPhone as well. Another negative thing for Apple is we're continuing seeing a lot of regulatory hearings. In Europe, the Digital Market Act is prohibiting Apple from rolling out its smart AI, while in China, the rollout is also subject to regulatory approvals. And Europe and China together takes about 42% of their entire revenue. So when AI features is already not showing clear evidence that it's driving product growth, and then half of the places you can't even roll out your newest features, it is just very hard for us to foresee what comes next at this point. So we're still very cautious. We have a neutral rating with a target price of $290. That's all from me. I'll pass my time to Fahmi for the software updates.
Thank you, Elena. Good morning. Our theme for software sector is that investors need to be selective with the software names. Software shares remain under pressure as year-to-date with the sector derating from the AI displacement concerns and rotation into the AI infrastructure play. Next slide, please. The software sector valuation remains under pressure. If you look at the presented chart, the current EV over sales ratio for the large cap software companies is trading at the -1 standard deviation level at 9.5. Despite the sector derating, we remain overweight on the software sector. The reasons are the first, resilient fundamentals. The last 12-month revenue growth accelerated to 17% year-over-year, a strong number, which is also the strongest in the last 14 quarters. And if you exclude the software providers, which are Microsoft and Oracle, because it is an outlier, the growth remains solid at 16% year-over-year growth for these software companies. The second reason is that software is the monetization layer of AI. Software customers need software to create, govern, secure, and operationalize their artificial intelligence into the business operation, and this makes software vendors the beneficiaries of the AI adoption. Our recommendation is to look at a company that will benefit from the AI to make it clear. Slide, please. The first company on our list is Oracle's, and our theme is that the sales will surge as the infrastructure hit full capacity. We expect the group revenue to continue to accelerate in the financial year of 2027, backed by the growth from its cloud business, Oracle Cloud Infrastructure, OCI. The inflection point is when the completion of the first phase of its target infrastructure project in Abilene, Texas, which is in partnership with OpenAI and targeted to be completed by the end of 2026 and fully hit capacity by the financial year of 2027, fully deliver their capacity. And this will boost the Oracle's capacity supply and boost their sales. And also other target facilities in the US region, which is under construction, will start deliver their cloud capacity in the calendar year of 2027, further boosting the sales. So we believe on the other hand, we believe there's minimal risk from the OpenAI. OpenAI should still be able to pay off its commitment in the calendar year of 2027. The financial power will come from the capital market as it listed out in the public market rather than its own business operation. We remain confident with the OpenAI success at the IPO upcoming, as the success with the SpaceX proof market is willing to pay premium for the AI frontier IPO. And OpenAI, if you look at it in the recent months, was able to raise $120 billion in the private market in March this year, which is higher than $65 billion. Anthropic latest private raise in May this year. So we are confident with that, and we are less concerned with the recent news where there's going to be a slight delay of the OpenAI IPO to the early of 2027 rather than the second half of 2026 as they initially planned. As the management guided, they are focusing on the financials, and we see these as a company is brushing up their financials before they went public. What could happen in the next 6 months is that they might better up the number for the full year, for example, acceleration in growth or narrowing the loss, better visual for the company before it went public, and able to raise the targeted IPO number. And with the surge in sales and slowing growth in the capex expected from the new funding capital program, we expect cash flow to turn positive in the financial year of 2029, and we have a buy call for Oracle at the $237 target price. For next slide, please. Next is Microsoft. Microsoft is our top pick for the software sector. Despite its massive scale, the company continues to deliver strong growth, with earnings grew about above 20% year-over-year every quarter. We continue to like Microsoft because it remains the world's second largest cloud platform, and there's few cloud providers capable of supporting frontier AI customers such as OpenAI and Anthropic, and they already have deep relationship with one of the large AI frontier model, which is OpenAI. So as this frontier AI company grows, the infrastructure providers such as Microsoft will grow as well. The company has been expanding aggressively to keep up, and they have the capital to do so. Unlike the rest of the application software vendors, Microsoft benefit directly from the rising AI infrastructure demand. If you look at the chart, AI revenue has grown above 20% in the recent quarter, and supporting the Cloud Azure business, which is growing at 40% year-over-year in the recent quarters. And these are the AI annualized recurring revenue is now making about 10% of the total revenue, which is material to the sales number. And this AI revenue, for your information, is coming from the software add-ons such as Copilot, coding application, and the Azure Cloud, which is enterprises use to develop their own artificial intelligence. So we see the company was able to generate clear AI monetization amount, and while many of the software companies struggling to demonstrate AI monetization. And for that reason, we have a buy call for Microsoft at the $540 target price. That is all from me. I will hand over to Iqbal for the semiconductor sector. Thank you.
Yeah, thanks, Fahmi. So for semiconductor, we think the current pullback is a great opportunity for shareholders to add more semicon stocks into their portfolio. We think that the recent share price rally over the last 3 months is mainly driven by earnings surge, because the SOXX semiconductor ETF is up about 90% year to date, whereas for the first quarter earnings itself, semiconductor counters experience more than 200% year-on-year surge in earnings. So we think that this earnings growth more than supports the rally in share price. Yeah, next slide, please. Yeah, so this is the semiconductor counters that will benefit from this AI search. So we break them down into the different categories. First one is processor, as well as memory counters, equipment counters, as well as foundry. So in this table itself, we have two red boxes. The red box on the left shows the revenue growth year on year for the quarter ending March, whereas the red color box on the right shows the guidance that that management has provided for the quarter ending June itself. So as you can see, for most of the semiconductor counters itself, most of the management has provided guidance that revenue growth will accelerate for the quarter ending June itself, and this will be announced probably end of this month as well as in August itself. For example, counters like AMD, Nvidia, Broadcom, as well as equipment makers, Applied Material, and Lam Research. All of this management has provided guidance that revenue growth will accelerate. And this is being supported by hyperscalers' increased capex guidance as well as increased capex guidance from memory players as well as TSMC. Yeah, next slide, please. Yeah, so going on to our first counter for NVIDIA itself, we do think that NVIDIA's ACIE segment will be the next growth driver. So in the latest quarter itself, NVIDIA broke down its data center segment into two. One is hyperscale, one is ACIE. So for ACIE, it refers to AI cloud industrial and enterprise, and it includes the revenue from AI native clouds, sovereign nations, as well as the 250,000 enterprises worldwide. And so for the previous quarters, the growth has been mainly driven by hyperscale. So for ACIE in the most recent quarter, the revenue growth was about 74% year on year, whereas NVIDIA's total revenue growth is 85% year on year. So we do believe that the reason NVIDIA CEO broke down into this reporting standard is because he sees growth accelerating for this ACIE segment itself. And we can see this being supported by Nebius and CoreWeave's CapEx guidance, because Nebius and CoreWeave, they provide AI cloud infrastructure and compute solutions to sovereign nations, and also enterprises want to reduce reliance on hyperscalers. So, and their combined 2026 CapEx is expected to surge almost 300% year on year to $80 billion. So we do think that going forward, this will be the new growth driver for NVIDIA, and this is being reflected by the chart itself. We have a higher than consensus expected growth in this segment itself. Yeah, next slide, please. As for AMD, we do think that it is holding strong against competition, mainly NVIDIA. So in this chart itself, this shows NVIDIA and AMD's data center revenue. For NVIDIA itself is the blue color line, for AMD is the yellow color line. And AMD guided server CPU revenue to spike up more than 70% year on year in the second quarter because of the surge in CPU demand, especially with the adoption of agentic AI. And in the most recent pre-quiet analyst call itself, which we attended, AMD indicated that customer pull for MI450 is strong, and MI450 revenue is expected to surpass MI350 revenue in the fourth quarter of this year. So MI450 is basically the next generation GPU. So that is expected to begin to ramp in third quarter, and then the main bulk of it will come in fourth quarter of this year. So we do see that bump in terms of data center revenue in the fourth quarter of this year, and we see it keeping very closely to NVIDIA's product cadence as well, where they are expected to ramp their Vera Rubin GPU starting from the second half of this year. Yeah, so we still have a buy call for AMD. Yeah, next slide, please. Yeah, as for Micron, we do think that the recent share price rally is mainly driven by earnings surge and not because sentiments have run. So Micron share price was up about 300% as of 30th June, and this is being supported by its revenue and PATMI growth. So its first quarter revenue surged by 346% year on year, and PATMI surged more than 12 times year on year. So as you can see, the blue color line shows Micron's forward PE. Currently is still below 20 times. I think it is about 13 times after the most recent drawback. the most recent drawdown. And the yellow line shows the average forward PE over the past expansion cycles, all the way back till 2005. So over the past 20 years, we see about 9 expansion cycles, and each of these cycles lasts about 4 to 5 quarters. So the average forward PE can be seen in the yellow line. We do think that Micron still has room to run because it is currently in the 10th month. So there's still a few more quarters to run compared to its historical. And we also think that because Micron recently secured strategic customer agreements that last all the way to 2030 itself. And these strategic customer agreements represent memory chip volumes of about 20 to 30%. So we do think that this will break the boom and bust cycle experienced by Micron traditionally. And we do think that that's why there is room to run for in terms of its forward PE. And that's why we have a buy call for Micron and also a target price of $1,870. Yeah, so that's all from sorry, I think there's one more conclusion slide for the entire US SSP. Yeah. So in conclusion, we do think that third quarter itself is an AI monetization test because market will now pay for AI revenue and not just the AI ambition itself. So as what Graham mentioned, we do prefer to own names with receipts, with company's ability to show that it can monetize its AI revenue. And with the Fed on hold, we do think that cash today beats promises tomorrow. We think that US Bank can compound record NII and IPO fees with zero capex risk. Across the sector itself, we do think that semiconductor is the earnings engine. Software is derating, so we prefer to stay selective. For digital ads, it is monetizing AI precision, and e-commerce is seeing a rebound, and hardware is currently still trying to fight the rising memory costs. Our topic for the entire overall outlook for US banks is Wells Fargo, for semiconductor is Micron, for software is Microsoft, for digital ads is Reddit. Yeah, so that's it, the conclusion. I'll hand over the time now to Ashin. Thanks.
Thanks, Iqbal. I'll go through air transport sector update. Next slide. So for the month of June, we observed that SETS had one of the stellar performance with a share price increase of close to 14%. This was followed by SIA at about 11%, SIA Engineering at about 7%. China Aviation Oil had some share price weakness of close to 1% for the month of June. The US-Iran interim peace deal that was made last week pushed down jet fuel prices, but it's still about 30% higher than 2025's average. And just recently, Brent crude oil prices have also increased about 4% due to renewed US-Iran conflicts and attacks. So we feel that the jet fuel price volatility risk is still going to stay. It's going to take some time before we are going to observe any complete de-escalation. And what this means for airlines is better hedged airlines like Cathay, Singapore Airlines, Japan Airlines, as well as ANA. These airlines have strong hedging profiles where Singapore Airlines has hedges on jet fuel and crude oil. The other regional carriers mentioned have a hedge on crude oil in specific at a 10 to 30% proportion. So they are less exposed to jet fuel price increase. When we contrast this to your Chinese airlines, the Chinese big three, which includes your China Eastern, China Southern, as well as Air China, they are largely unhedged, which means they are absorbing all of this jet fuel price increase directly. And this also means they have to increase their fares much higher compared to your hedged carriers. So we think despite all of this, demand has been resilient for air travel overall. For SIA, for example, they ramped up capacity and they were able to capture the rerouted demand from Asia to Europe. So on the cargo segment, recently the Middle East air carriers grounded some aircrafts, and as a result, there was lesser aircrafts available to ship your cargo around, and that meant that your cargo rates from your Asia to Europe route increased about 38% year on year. So rates increased, which is good news for aircrafts that have a sizable proportion of cargo revenue. And these include your China Airlines, EVA Air, and Cathay, which have a cargo revenue proportion of 20 to 30% of total revenue. SIA has about 10% of total revenue made up of cargo, so it's also a secondary beneficiary. Next slide. So the chart on the left, what it shows is that this is the futures pricing as of last week. So what the market predicts is that jet fuel will normalize or price in normalization by 2029. So if jet fuel prices are higher for longer, that's going to affect your unhedged carriers the most, and they will be affected more as compared to your hedged carriers. And the chart on your left, what it shows is that your aircraft backlog to delivery ratio is about 60 times, which means there are the number of aircraft that has yet to be delivered compared to what's being delivered every quarter stands at 60 times. And the lowest it has been for the past 4 years is about 30 times, as you can see. So this backlog is not going anywhere. It's still persistent. And we think it's going to take some time before we see deliveries normalize. So recommendation wise, we have neutral on SIA at $6.43. SIA's main drag is its Air India associate, which it owns a 25% stake in, and that is eating into its earnings. And we do not think Air India will be able to turn around soon anytime. They do face some cost pressures due to their currency, as well as some internal cost controls after their merger with Vistara. And so we have a neutral on them. For sets, we have a buy on them, $4.52. Their main mode is their global network. They are one of the few, or if not the only, cargo logistic firm that has a global network, a global mandate, and they have cargo hubs at key transit hubs. And this allows them to service their airline customer at different locations they fly to. And that is really their unique selling point, which makes customers want to recontract with them. For China Aviation Oil, we have a buy $2.53. So the merger of their parent company CNAF with Sinopec is complete, and so Sinopec is indirect controlling shareholder. So we are looking out in terms of how China Aviation Oil will sit within this broader network, and that is important for us because we are trying to determine what there is another subsidiary of Sinopec called Unipec that also does refined products trading. So we think that if China Aviation Oil is a dedicated subsidiary for international refined products trade, then its volumes would increase. Apart from that, their Shanghai Pudong International Airport Associate is expanding, and that would also lead to higher earnings for China Aviation Oil. For SIA Engineering, we have a buy on them. So as we saw earlier, the backlog of aircrafts is still there, and recently SIA Engineering signed a non-binding MOU with Air India, and Air India is aggressively expanding its fleet to over 500 aircraft. So this will be a multi-year MRO revenue cycle for them if it becomes binding. So with that, I will pass on to
Yeah, thanks, Ashil. I'll move on to the technicals. Next slide, please. Yeah, so for the first half of S&P 500 last week, we saw some gains. It was up 1.2% for the week. So in terms of the daily time frame, I think currently price is trying to break out this wedge consolidation, especially on Thursday and Friday. This wedge consolidation took place since the beginning of June. So I think overall we are likely to see a retest of the all-time highs ahead in the days to come. With the resistance currently at 7,577 to about 7,620. And this will also likely retest this key trendline resistance that has formed since 2023. And also, in terms of current support, I think with the current pullback, I think price could still find some support at the recent short-term moving averages like the 5, 10, and 20 SMA area. So that's about 7,475 to about 7,540 area. So could be still a bit range bound and try to test the high afterwards. Next slide. Okay, next one. We looked at some of the performance of the Singapore and US IPO. So for the Singapore's one, we look at the recent listings that took place last year as well as this year. And then for the US IPOs, we looked at those blockbuster IPOs. So a few tables. So first one, this table shows the performance for those Singapore IPOs listed on the main board. So we can see that overall, it shows the 1-day return up to about 12-month returns for those that were listed earlier last year, like Infotech. So in general, the performance has been quite lackluster. We can see that new listings generally return about -2% return from the first day from the IPO price. And then only about 1/3 of the IPOs close above the IPO price on the first day. And then this performance has kind of worsened this year with the 3 listings that we saw from UI Balstic, Jasco, as well as Foundation Healthcare. On average, we see about close of -11% on the first day. Yeah. And then overall for the part from last year, the best performing main board listing has been Centurion Accommodation REIT. So that has seen positive returns from the first day up to the 6-month returns currently. Next slide. Next one, this table shows the performance for those listed on the Catalyst board. So generally, we can see a lot more green over here. This contrasts sharply with the main board performance. So for the Catalyst listings, they generally see a very reliable double-digit opening day pop. So that's close to about 20% returns on the first day on average. And then we can see that the gains also tends to extend through the longer time frames afterwards, like the 1 week and 1 month. You still see about 50% returns on average from the IPO price. And then the best performing Catalyst listings, I think, was Meta Optics as well as Lam Chang Creations. By 1 month, you can see the share price actually double. Yeah, so I think we can see that the Catalyst board listings have performed better. Next slide. Then this one, my last table actually shows the top 10 largest IPOs listed on the US stock exchanges. So you can see from with names such as SpaceX, Alibaba, Facebook, Uber, and so on and so forth. You can see that generally it's quite positive early on, but the returns tend to be dragged down afterwards. So on the first day, on average we tend to see about 16% gain on the first day from the IPO price. And it's quite reliable on 9 out of 10 these blockbuster IPOs, with the exception of Uber, which was down on the first day. And then the returns kind of extend from the 1 week to 1 month return. It's still generally positive, but from the 3 months return onwards, I think that's the key timeline that we can see the share price will likely start to weaken up to the 12-month period. I think that also coincides with the expiration of lockups, which tends to be 180 days on average for US IPO. And then by the 1 year mark, about 12-month returns, we tend to see that comes to about -17% for US IPO. Next slide. Yeah, so in conclusion, some key points is that Singapore main board IPOs generally quite lackluster, we tend to have a negative return on the first day. And then if you're looking for a trader that's looking to speculate in terms of short-term IPO speculation, I think the Catalyst board listing provide a better risk to reward profile if you look at the opening day gains as well as some of the very short-term gains following through afterwards as well. Then if you're looking to speculate in the major US IPOs, I think the optimal strategy would be to ride the initial the momentum wave. So that's about could be up to from the opening date of about 1 month. And then it's recommended to exit positions before the lockout expirations, especially from the 3-month period afterwards. And then we can also see that if you buy in a whole a major IPO for about 1 year from the IPO. It's generally he has been value destructive for investors. Yeah, so that's some of the key takeaways looking at the Singapore and US IPOs. So I have time to Paul. Yeah, thanks.
Yeah, thanks, Zin. So we just quickly run through our usual weekly update. So in terms of the macro news, I think in general, retail sales was generally stable, but supermarket was quite sluggish, so 1.1% in May. So probably not so positive for Sheng Siong. But somehow watch demand is very strong in Singapore, likewise for electronics. In terms of construction awards, one thing you can take away is that it's been quite weak year to date. The construction awarded is quite flattish or down 5%, but the payments is up 17%. So we still think this will be positive for all the building material companies because they are the ones fulfilling the orders right now. Just that in terms of the like the order book for the awards is down. In terms of some updates on Comfort's taxi fee is still coming down, although it's a slower pace. I think last year was exceptionally bad. I think they were losing like almost 70 taxis a month. Right now it's about 7, so it's come down, but it's still contracting. So this will still be a drag on earnings because these rents are technically pure profit. Because if you're renting, if you don't rent, you got a zero income. But if you rent it over your fixed cost will still be there. I mean, the taxi still be there. So the 6% is down, but actually in terms of impact on earnings could be even more. So for Korean exports, it's still very vibrant. We have a chart on the semiconductors, but it's still a very vibrant export sector, not just in Singapore, of course, but exceptionally strong in Korea and Taiwan, driven a lot by semiconductors. Next slide. So in our tactical views, just to follow up on what Zane mentioned, we have another chart on just the stats of all these IPOs. So of the 17 IPOs that have been listed so far, since IPOs are returning to Singapore, 8 of the Catalyst continues to be the best performing. I mean, they gain like 20% on the first day, and like what Zane mentioned, you can actually even buy on the first day and still on paper should actually capture more gains after the first day. Main board is the worst. It's a loss of 2% on the first day, and only 3 of the 9 IPOs reported a profit on the first day. So, i.e., is like 1 in 3 chance if you're going to apply on the ATM. And then so far this year, all the 3 IPOs are down on average about 11%. So just on IPOs on its own, I think in theory, I mean, this is just in theory, it's always going to be hard to find bargains in IPO because it's not like stock trading, everyday stock trading. Your counterpart or the seller is probably the most well-informed and well-informed seller. I mean, he knows everything about the business. He's selling it to you now, and he's probably going to price it to perfection. And what makes it worse now is that the investment banks would like to secure the deal. To secure the deal, they're probably going to price it aggressively. I'm referring more to the main board now, of course, not so much to Catalyst. But the last time we had a boom in IPOs, at least on the first day, was during the S-chip boom, the 2005, 2007. And during those times, the valuations were more attractive. I didn't take every one, but I just took the sample of some of the larger ones. You're talking about 6 times PE, 11 times PE. Versus some of the valuations coming out now, what, 20 times of foundation, and then for Jasco, I think it's probably 100 times. You're talking about historical valuations. And the third reason is that the current vintage of IPOs is not the most appealing. So most of the IPOs coming out on the main board are like property, REITs, healthcare. It's not like my portfolio need another REIT or property or healthcare. So that's the other issue. Unless if you're coming out with tech, then I think it'll be more appealing for investors. And the other problem you have is that most of these IPOs, only 0.9, a very small portion of it goes to the public. In general, only less than 1% of the shares go to the public, and of the total offer in general, including the cornerstones, only 3%. That means it's insignificant. I mean, 2.5% of the offer actually goes to the public. So even if it's good, also the public may not get a chance to get the shares. So that's why it's not so much a initial public offering, it's more like a initial private offering, since the public don't get much shares. And for the catalyst, some only offer 1 to 2 million shares, maybe worth 200 to 400,000. So you won't get anything for during the IPO stage. Just one data point. So on back to semiconductors, I think the momentum is still very strong. You're going to see the unprecedented growth. So semiconductor exports in Taiwan is up 30%, in Korea is up like 200% year on year. Even the world semiconductor billings is up 118% in May. So this is a May number, you don't have June, but you can assume that the demand for semiconductor continues to be robust. I mean, this is the latest data points, I guess, if we use June exports. And the semiconductor sales now are annualizing at about 1 trillion. The events, these are some of the key events. A lot of banks coming up, and also you got the main semiconductor be ASML and then TSMC and Netflix. And at the bottom these are the corporate insight webinars. EGP battery, I think it's a new IPO coming up, and are they still doing this? Okay, but let me have to double check. I'm not sure is this still on or not. Yeah. I think I think the EGP Energy Insight, I think they might have delayed it. Apologize. Yeah. Then yeah, these are some of the other corporate insight webinars. Next slide. Okay, so this is just to show you the construction awarded. It's trending at almost 50 billion a year for Singapore, and the red line is payments. Just think of the activity. All the jams, all the work that you see on the road these days, blocking your car maybe. The one on the right is just the taxi fleet. So on the blue line, actually taxi fleet was generally stable, but then in 2025 it really collapsed significantly. I think it coincides with the arrival of Grab2 coming up with a lot of aggressive offers. The contraction is still there, but I guess at a lower pace, but it's still contracting. The next slide. Okay, so this is a very complicated, not complicated, but let me just explain this chart since there are so many numbers here. We try not to do this. This is not a okay, so on the left is the company. So these are the most recent IPOs this year, and then some of the performers. And then at the bottom, you got some of the S chips. That's a snapshot. So then you got IPO price. So public means the amount of shares available to a public. So if you look at some of these, like the Assembly Place, only offered 2 million shares to the public at 23 cents. So there's only 400,000 available for the public. Sometimes they put it lower so that when they advertise, they say that, oh, this IPO oversubscribed by how many 100 times, but only because you give so little shares, right? Meta Optics even worse, the best performing IPO, like what Zin mentioned, they don't even offer any shares to the public. I guess we know where it went. Then most of it is placements. And then these placements, then normally there's also cornerstones. So having a large cornerstone also doesn't help. Or you can call them contrast stone, because there's no moratorium on the cornerstone investors. It's more like advertisement to show that there's a lot of institution buying, but the institution can also sell on the first day, which is pretty evident if you look at some of these IPOs like Foundation and Justco. So these are because there's no moratorium, yeah. And then the table there, total means the total number of shares. The rest is just the total of total number of shares. So for Foundation, the number of shares is 1.329 billion. Yeah, yeah. And then the shares on offer is 23.9% of the total shares. So just how to understand this chart. I highlighted in red just for you to know that of the whole number of shares, only 0.7% of Foundation goes to the public. 11.5 is placement, and then 11.7 is cornerstone. One way to sometimes assess whether the IPO will be a good IPO is, of course, the amount available for public and also the cornerstones. So usually cornerstone should be 70%. It's not foolproof, but if the cornerstone is pretty poor, low, it also shows that there may not be enough placement demand. In general, it's not all the time. Yeah, anyway, this is just for your reference. And then at the very last two rows, so these were some of the big S chips that were listed in 06 and 05. They were normally listed at about 6 times and 11 times PE. That made it more attractive. Like Foundation, I think they're listing it at about 20 times PE. Yeah. For whatever reason. Next slide. Then this is my last slide. This is just to show the spike in semiconductor exports out of South Korea and also out of Taiwan in red. And then the one on the right is just global semiconductor billings, just for reference. It continues to grow very strongly. So this is a 12-month growth, trailing 12 months. So on an annualized basis, it's still growing about 56%. Just to remove the monthly volatility. Yep. Okay. Thanks, everyone. Can move on to Q&A.
Thanks, Paul. Let me take some of the questions first. I see a few questions. Sorry, give me a minute. Yeah, I guess this one I was sort of expecting it, right? Asking why did the Singapore banks rally so much last week? Any news or data? Yeah, so there isn't any specific news or data. I mean, I can think of several things that come to mind. The first one, basically, there's some expectations of the results to come in quite strongly in the second quarter because fee income is showing very strong growth, and also we are seeing some uptick in the interest rates as well in Singapore interest rates, which should only benefit their margins and also their net interest income. And then the other factor that will help to bump up the net interest income is loans growth. So the data that is out by MAS, right, for Singapore loans growth is very, very strong. It's like 8+% kind of loans growth, which we haven't seen for almost, I think, for 3 or 4 years already, that kind of levels of loans growth. So that's very positive for Singapore banks. Another thing that that could have possibly bumped up the share price for the banks would be maybe I think Citibank came out with a very positive report, right? So that drove some of the insti demand, I guess, for the Singapore banks. Another one which also could be, right, is that I guess the US-Iran deal fell through, and then now they're just bombing each other again, which causes there's expectations that the rates will definitely be kept relatively stable, or even some hikes. So that could also have caused it as well. Where there's also a bit of a more outflow from the more volatile stocks into something more safe haven, right? Which Singapore banks especially fit all the right criteria, right, for safe haven inflows. So that could be one of the other reasons as well. A lot of reasons for this sudden uptick, but there's no one particular news or data that caused this surge. Yeah. So what's my expectation for the US banks earnings? I think it'll be very stable. There should be very broad-based growth, right, for second quarter. And this will be banked on the stronger loans growth, right? Like what I said earlier, if you when I was talking about the US banks, right, the tech sector is still growing, and then the banks, right, are the ones that are reaping all these benefits, and they don't even need to do anything. They just sit there and wait for them to come, and say, okay, I give you this loan, give you that loan. And then the investment banking fees also, because all these companies are wanting to IPO, so they will reap the benefits. I think all the top 3 banks, I think maybe only one of them maybe didn't get the deal, but I know JP Morgan for sure will be involved in at least almost all of these IPO deals, and then they will just flow through as a fee income for them. One thing to watch would be their guidance on the margins. So only they can really tell us where would they be able to see margin moving, with now the whole rate environment sort of shifting a bit, and also their outlook on provisioning, whether or not they will be whether is it enough. We believe it's enough, right? But I think it's more for confirmation from the banks themselves to tell us, okay, yeah, there is enough, and we will be kept relatively stable at least for the next however months, maybe the next year or so. Yeah. Yeah, which is a better buy, OCBC or DBS? Yeah, so thankfully we chose 2 of the ones that we like. I would say DBS is still our top pick, right? I always talk about the 4 boxes, right, that the banks have to tick, at least the Singapore banks have to tick. And DBS actually ticks all 4 of them. So the other 2 banks like OCBC and UOB, they tick maybe 1 or 2 boxes. right? But DBS is the only bank in Singapore that ticks 4 of them. So what are these 4 boxes? First one, margin stabilization. DBS has shown that quarter on quarter they are able to actually increase their margins, right? Their net interest margins are rising, so they are able to move around the deposit inflow they're getting in order to stabilize their margins. Second one, double-digit fee income growth. So DBS has shown that they are able to get a very strong fee income growth while keeping margins stable. The third one is the dividends. So DBS has that dividends, very strong dividends guidance, right? They are the only bank that has given an absolute dividend per share guidance. The other two is still based off this dividend payout ratio of 50%. So there's a risk there that if the earnings fall, which we have seen like in the fourth quarter last year, where the earnings actually dipped, right, because of the margin and the rate environment, then they actually slash dividends, right? So for DBS, they're saying, regardless of however much our earnings go down, we will be giving you this amount of dividends. And it's not like they're giving maybe 55% or 60% dividend payout ratio. It goes all the way up to 70-80% kind of payout ratio. And that's the highest amongst the 3 banks. And the last box, which is a guidance upgrade, right? They're the only bank that has given any form of upgrade to their guidance in the first quarter. So they rose their top line guidance, saying that now it will come in around FY25 levels for total revenue. Previously, they were saying that it will be slightly below, I think, the FY25 levels. So that is the main reason why we chose DBS as the top pick over the 3 or among the 3 Singapore banks. Yeah, any view on Skylink outlook for the short to medium term? Yeah, so I also have been speaking to the Skylink management and also talking. I even went for a site visit, yeah, but it was a very short one. So for Skylink, they do a lot of their auto leasing, right? So that's their main business still. But now they're also doing a bit of MRO, and a bit more of they call it engineering side, where they fix and repair and paint the vehicles, right? More specifically, they paint the buses and larger vehicles. So the outlook, I would say I think they're moving towards this engineering side because the margins are better for them. And when it comes to the leasing side, right, of the business and the financing side, it's very small, I would say. There isn't much room to grow in especially in Singapore, right, where you have the COE as well. And it's just capped. So for that side of the business, which is still their main business, about 50-60%, maybe close to 70% of their revenue, it's more of a consolidating play, right? Where they will try to acquire as many smaller companies and then to consolidate. So that's where the growth is coming from, right? From M&A. And the other one, the engineering business, that's where they will be beginning to take market share. And they can grow that, but they will need the space. So they do need quite a lot of space to grow that side of the business, the engineering arm. So I think that's where it is headed. In terms of the outlook, it really depends on how well they can scale their business up. So for now, they have like 1 or 2 of that. I saw this like huge painting. It's like a box you put your vehicle in, the bus, you can put a double-decker bus inside, and then it will auto spray for you. And it takes like a few hours to do it. So I think they only have 1 of that now, right? So whether or not they can continue to buy or purchase more of these painting boxes and then have more room, because now they're just capped in the terms of the space. They cannot accept any more vehicles because they don't have the space to do it. So if they can move forward and if there's room for them to grow, and then they can win more contracts. So that's where the engineering business will grow, and I think that's where the main growth will come from. Yeah, because the margins are much better. They're getting like almost 70-80% kind of margins from that engineering side. Whereas the leasing side is way much smaller. I think you're talking about like 20-30% maybe kind of margins. Yeah, so I believe that's where the outlook for them. Yeah, okay, sorry. Yeah, so yeah, someone asked this question whether or not for the TP. Yeah, we keep a lookout for it. We are definitely looking at it. When there's any update, we will be sure to inform you, and we will also release a report if there is any update to the TP. So keep an eye out for that. Yeah. We will be we are taking a look at it. Yeah. We will publish it like if there's anything. For the TP for the banks, the 3 local banks. Okay, let me hand it over to the rest of my colleagues. Thanks.
Thank you, Glenn. I guess I'll take over. So what's the implication of Apple OpenAI lawsuit for both sides? So just a little bit context for people who don't really follow. Apple is claiming that OpenAI, when they're trying to hire Apple formal employees, which is legal, they're trying to systematically playing Apple's confidential hardware know-how through these employees. So they tell them that, oh, when you come to the interview, you should bring like some confidential info to us in an attempt to accelerate OpenAI's own AI hardware program. So of course, OpenAI denies it. So the implication on the Apple side, of course, Apple is trying to protect its strongest moat because its competitive advantage has always not just been software, it's also its hardware engineering, its manufacturing processes, its relationship with all the suppliers. So these are extremely difficult for its competitors to replicate. So if Apple believe that OpenAI is using this inside knowledge to shortcut years of engineering, this is exactly what you expect Apple to do, right? And I guess also, I think it buys Apple time. So even if Apple doesn't ultimately win, litigation will slow the hiring, slow the engineering, increase the legal review, and make their suppliers more cautious about who to collaborate with. So every month that OpenAI spends fighting the lawyers is 1 month that Apple has the time to actually speed up its own AI products. And I guess it's also trying to send a message, maybe not just to OpenAI, also aiming to Anthropic, Google, Meta. The messages if you can hire, but just don't ask for confidential information because we're gonna come after you. Yeah, but I think it also highlight that maybe 5 years ago, if this happened, Apple probably wouldn't even care. But now it's starting to really see OpenAI as a serious hardware threat. On the OpenAI side, because OpenAI just, I think it recently just acquired the hardware company. So now if the core hardware effort is under legal attack, it's a little bit headache for them. And also because they're coming with the upcoming IPO as well. So any major unsolved lawsuit could become a risk factor for the OpenAI. So yeah, but ironically, even after this, and even previous conflict when OpenAI was complaining that Apple's integration of the ChatGPT into their system is not as integrated as they thought. I mean, after all the conflict, ironically, they're still business partners. Apple still integrates ChatGPT, and OpenAI still benefits from the Apple users. So it's I think it's a norm now in the AI industry where everybody is sort of partners and sort of competitors and sort of opponents. So it's a very interesting circumstances now. Yeah, so I hope that answers your question. And I saw another one that's asking about Netflix results. So I think Glenn's presentation earlier also showed Netflix share price crash quite a bit. So it is a very perfect example of how a company is executing everything so perfectly, but just the market expectation of the company is just too high. So there's not really like a clear reason why the share price crashed. If you really have to pick a reason, it's because their latest earnings, their guidance for the next quarter is a little bit soft. It's not even soft, it's just a little bit, like 2 percentage point lower than usual. And as people start seeing it as a negative sign that maybe the growth is slowing down. So I guess this time's earning, we're really focused on how the content slate is going. So it has been going really well, and how the monetization is going. Their monetization has been going really well so far as well. They managed to increase their price twice last year, and they didn't really lose a lot of subscription because of that. They're also trying to push their advertisement services a lot. So they already doubled it last year, and they're aiming to double it again this year. So we'll also be paying attention to whether they're on track in terms of that. And I guess the biggest figure that people are going to be eyeing on would be their next quarter guidance. So whether there's still going to be a slowdown. So yeah, overall, it's a company that I would say is the clear leader in the sector that it operates. It doesn't really have a competitor that can really compete with it. Its monetization is twice as better as its strongest competitor, which is Disney. So yeah, I hope that answers your question. That's all from me. I pass my time to the colleagues.
Yeah, thanks, Helena. Firstly, is Manxiong Engineering a construction company announced orders this morning and share price looked cheap? Not exactly. I think not exactly like traditionally lah. Like in terms of if we see industry contracts awarded, in terms of government build-outs and private sector contracts, it would not directly benefit Manxiong Engineering because from based on a brief search, they provide the manpower, tools, equipment for other sectors, for example, petrochemical. Yeah, so they are not exactly construction company in the sense that they will benefit from this uptick in construction orders in Singapore. Yeah, not a direct beneficiary. I think there's a few questions on SK Hynix. Let me just indicate those. Yeah, so firstly is on commenting on SK Hynix, our TP. Next one is what is our view on SK Hynix and compared to the companies that are mentioned in our list. And last but not least, I think, does it have an impact on Micron? Yeah, so I'll just address these three questions. Firstly, we don't cover SK Hynix, so we don't have a TP. Yeah, so for context, they are also in the memory space. They have the largest market share in high bandwidth memory. They have about 56% market share. Compared to Micron, I think Micron is about 15 to 20%. Samsung as well, about 20%. Yeah, so SK Hynix has the largest market share. It is quite pure play in the sense that it is mainly involved in the high-end AI space. Yeah, so that's the good thing about investing in SK Hynix. It is quite a pure play memory, pure play investment in memory. However, I think compared to Micron, I think I like Micron more because it gives a better visibility going forward. Like for example, Micron mentioned that it has signed the contracts with its customers. It mentioned its remaining purchase obligations for that's like the order book for Micron, which is about $100 billion. And Micron also mentioned that they receive about $22 billion in deposits for the agreements. Whereas for SK Hynix, they only mentioned that they mentioned that they are receiving longer term multi-year supply contracts, which doesn't really give much color on their demand visibility. And Micron is also based in the US compared to SK Hynix in Korea. So I think that gives them a better chance of securing contracts. For example, if the US government helps them to broker contracts. Yeah. So I think Micron is better positioned in this sense. Whether or not the listing of the ADR have an impact on Micron, I do think that SK Hynix will experience expansion in valuations. Currently, it's about 7 times PE after the first day of trading. So I think its valuations will expand further, closer to its processor average of about 35 times. Yeah, because I think the boom and bust cycle will experience a structural decrease because of these longer term agreements. Yeah. Hopefully that addresses the questions for SK Hynix. Yeah, sorry. Let me see. My views on when the tight supply of memory chips will ease off. I think the supply will still remain tight at least to the second half of next year because the building of new fabs will take about 2 to 4 years. In terms of visibility wise, the new fabs will start to come in next year itself. For example, Micron has 2 fabs. I think it's Tongluo and one more. I forgot the name, but and then for SK Hynix, it's also their Yongin fab in Korea. Yeah, so the supply will start to come in next year. Yeah, but the demand will still remain very high for memory. So we think this tight supply will last at least till the second half of next year. Can I share about Samsung's results last week? If we look through it, looks good, but the share price dropped a lot after. Yeah, so Samsung, they provided a guidance. It's not exactly a result. So the guidance only included revenue guidance as well as the operating income guidance. So the revenue fell slightly short of expectations. I think it was so I think it was 171 trillion Korean won compared to expectations of 172. So maybe that's why the share price has dropped after the guidance. Yeah, but this 171 trillion is still about 240% year-on-year growth. It's still a very impressive growth. Yeah, so maybe it's just it didn't meet the expectations. What can we expect from ASML, TSMC results this week? I think TSMC guided a softer growth because its April and May revenue was softer as well. It increased 24% year-on-year. Compared to first quarter revenue growth, it was 41% year-on-year. So TSMC only guided a 30% year-on-year growth for second quarter. I think that will be priced into the market because people are expecting this quarter to be softer because of pull in of demand in first quarter itself. However, I do think that there's a big chance that TSMC can exceed this expectation because demand is still strong as indicated by the hyperscaler customers as well as the chip designer customers like Nvidia, Broadcom. For ASML, also similar. They also guided a slightly softer revenue growth of about 12% year-on-year for second quarter. First quarter, it was, I think, 13% year-on-year growth. So a slight deceleration in guidance, but we think they are able to exceed this guidance because DUV demand is strong, especially from memory. And also, we think ASML will experience a surge in services revenue because memory players are trying to squeeze out as much supply from the existing clean room space. So existing equipment itself. So we are expecting this surge in services revenue for all three equipment companies. Yeah. I think I'll hand over the time to my other colleagues. Yeah, thanks.
I'll go through one question on OUE REIT. So what's the impact to OUE REIT given Deloitte is moving up to just core office? So context is OUE REIT, which Deloitte, which has about 150,000 square feet of office space at OUE downtown, is moving out to a Just Coast office in Orchard. It currently makes up about 5% of portfolio revenue for OUE REIT. So it's not super substantial, but for a single customer, 5%, it is a pretty big proportion of revenue. So the impact will be a hit to your top line if OUE REIT is not able to backfill this space. So the lease itself expires in 2025 December. So they have about a few months left, and currently Deloitte has been renting the space at below market rent, about $8 per square feet, whereas your grade A CBD office is going at about $12 to $15 per square feet. So we think OUE REIT may not really face a challenge in backfilling the space, but the question will be how quickly they will be able to do it. So that's something we will be looking out for OUE REIT. Yeah, that's all.
Yeah, Darren.
Yeah, let me see. Yeah, there's one question on GokuLand and Hong Kong Asia. I answered the GokuLand. So GokuLand, yeah, their investment side has been doing very, very well. So their Goko Tower, Goko Midtown office is basically 100% occupied, as well as the retail portion. So the investment management is doing good. For property side also, there are recent developments like the River Modern is also over 90%. So that's despite it being in the CCR. Yeah, so we do expect strong results from GokuLand, and also they have a pipeline of upcoming launches. I just slipped my mind what the upcoming launch is. Probably within the next few months. Yes, and also they are actively still bidding for new projects, new GLS sites. So yeah, the outlook for GokuLand is still strong. What's the outlook on the REITs going forward in view that Feds are likely to cut rates? There's potential for one rate hike by end 2026. Yeah, so you're right that there is potential for one Fed rate hike. It's also shown inside the dot plot that it's likely that they will have at least one rate hike, and the markets, I believe, as of now, is still pricing in that as well. Yeah, but for REITs, generally we see a lot of the REITs have already hedged a good portion of their debt. So even if we're expecting one or two rate hikes this year, the impact will not be that significant. Like for instance, just one example, we've seen ECB already raise rates. Not Cromwell, Stoneweg, they have about 87% of their debt on hedge rates. So we do not expect significant impact from that fact that the ECB raised rates by 25 basis points. And we're still expecting the cost of that to just inch up slightly from that. So that's generally the trend we'll see if the Fed does raise rates. But from a year-on-year perspective, we are still looking at like majority of the REITs still having at least a stable interest cost as well as a year-on-year, because base rates, like global base rates like the Fed funds rates, for instance, as well as the SORA in Singapore also, so those with SGD denominated loans, so it's also lower year-on-year by over 100 basis points. So we do expect some savings from that as well. Yeah, so generally, at least we believe 70% of the REITs in this year will still experience at least stable or still lower year-on-year rates. Yeah, so yeah, and for generally we are still expecting at least 2 to 3% DPU growth, mainly from stronger operations like the increase in rents, higher rent reversion, higher escalations as well, combined with the fact that the interest rates are generally stable. Yeah, so we think the outlook for S-REITs is still, I mean, it's not as good as when rates were declining for sure, but it's based on the positioning now, based on where REITs are trading, it's already kind of priced in a lot of this potential rate hikes as well, and higher for longer elevated interest rates. So positioning wise, it's trading around 0.9 times price to NAV. So it is still kind of attractive in our view. Yeah, thanks. I hand over to Paul. Thanks.
Yeah, thanks. Thanks, Dennis. Let me just quickly again just go through some fast ones. What is the stabilization trade seen in Foundation Healthcare? Why does this happen? So during an IPO, let's say I'll just give you an example. So during IPO, let's say maybe they are offering 100 million shares to the as an IPO, some cornerstone, some placement. Maybe 15% of it usually or more, they will keep as you call it green shoe or for stabilization. So although officially it's 100 million, if it goes above it, maybe 115 million, for example, then they will take this 115 million and go to the market like you see right now for Foundation. They have a stabilization of 24 million shares. I'm just looking at the data. They actually issued only for placement maybe 160 million. Then so there was more than there was oversubscription, mainly at the placement side. So they will take these shares and then go into the market and buy whenever it's below 76 or at 76. So technically, the investment banker who does this actually make money, because I sold it at 76 and then now I buy back at 73 or whatsoever. So that's why they call it stabilization. That means I offer 100, but I got more than 100 million in demand. Then I will just take that in and then use that money to go back into the market and try and stabilize. That means the vendor that sold it got to will take the money back, but then use the money to go back to the market and buy. Yeah, it's not confusing. But anyway, foundation stabilization was about 24 million. They bought about 18 million so far from the market. So another 6 million. So they'll probably do another 2 to 3 more days of stabilization. Then after stabilization, then good luck, because there's no more buyer from that side. Yeah, sorry, it's a bit confusing if it's Hi Paul, the share buyback announced by Geo last week significant. Yeah, the last time Geo announced a buyback was about 2023. So it's significant, but probably just more like a market signal. I don't think they are like 20-30% of the volumes, or maybe 10% of total volumes, but it's a signal. More important, I guess, it will be the second quarter earnings to watch for. I think with coal prices higher, about 30% higher year on year, that should help the earnings. And then more important, by August, I think by next month they should be already the new toll road should be on infrastructure. That means the toll road and jetty should be contributing to earnings. So that's something to watch for. That this will be the big growth driver because it's already completed. They're already doing the testing now for this $190 million road and infrastructure. Oh yeah, hi Paul. The briefing for Q&A announcement meeting. Yeah, okay. So I'm still trying to do the note because I think like I don't know 40-50 pages. They make 2 big acquisitions. So for us, it is positive because this will be EPS accretive. So making this acquisition, your earnings will jump. Then of course your PE will come down. So I think the PE will drop to maybe high teens, if I'm not mistaken. I'm just doing back on envelope numbers. And this acquisition has a profit guarantee of 9 years, and every year the earnings will grow because of the profit guarantee. And the shares that is issued is locked up about 15 years. So I'm not sure how he did it, but anyway, whoever sold the shares, the vendor, the Australian vendor and Thai vendor cannot sell their shares for 15 years. And the shares are issued at 70 cents. Q&M shares at 55 cents. So but in the broader context, it's positive because it will provide earnings accretion, of course, and also scale to the business and a new avenue to grow. At the minimum, there's a growth rate of I think about 14-15% per year because of the profit guarantee. Okay. What's your latest take on Hourglass? I'm trying to go to the AGM, but there seems to be a recovery in second-hand luxury watch price, and of course the data in Singapore very strong. So there could be some upside in this, but I really don't know. They don't want to meet analysts, so we're trying to go in through the AGM route. Hi Paul, on the IPO topic, why would Cornerstone investors want to sell soon after listing at the loss, as they also got the shares at IPO price? Please help me understand. Yeah, I'm also very surprised that they do that. I think because you only lose money, but that seems to be the phenomenon. Maybe you've seen these Cornerstone investors are like, playing Contra. So I call them Contra Stone. But I think the key message for investors is just that even though they got Cornerstone, it don't mean nothing lah. Because the share price also dropped and they don't seem to be. And Cornerstone might actually Cornerstone might actually be could actually be a negative thing because it shows if I'm an institution, I come in and I buy 5 million, that could be the maximum I'm willing to buy. That means there could be actually no more buyers. All the institutions that want to buy into this stock is really in there. So I'm not sure whether putting up Cornerstone news is actually good. Because you want like who will buy the shares after that. But again, I'm surprised somebody might be just going there for a short-term trade or for whatever tactical or nuanced reasons. Any view on the Alltech still weak, well below the target price? Yeah. My target price is 170 something. Sorry, 270 something. Yeah, assuming the acquisition goes through. So we are still positive on Alltech because assuming this acquisition, this contract that they want doesn't go through, we still think there could be other contracts that they're looking at. So this may not be the only SAF contract they're looking. There are also biodiesel contracts and other SAF contracts. SAF is a sustainable aviation fuel oil. Is Sembcorp a buyer? So we still like Sembcorp. I think the acquisition. Sorry, keep on talking acquisition. But anyway, the acquisition could boost earnings by at least 20%. But I think the market is a bit wary because it's already in the public that their renewable business may not be strong because their counterparts in India reported very weak renewable renewable means there was very weak wind, and also very weak solar, all due to weather reasons. Yeah, and nothing to do with the company. So, if there is some sell down during the results, then I think there's probably a better opportunity. Yeah. Okay, I'm going to hand it over to Zain, and I'll try to type in the rest of the questions. Thanks.
Thanks, Paul. I'll move on to the TA questions. Okay, so the first one is on Hong Kong land. Yeah, so for Hong Kong land, I feel that currently share price is still in a consolidation phase since like middle of June over here. And then I think yeah, so it's just moving sideways with key resistance still around about 730 or 745. So we see look at the Bollinger Band is also contracting. So I think for now probably not much volatility. But I think key level, if it breaks below this $7.15, then there might be some further weakness towards about $7 thereabout. So probably still quite range bound yeah, for Hong Kong land time being. Next one is Tech. Yeah, for Tech, I think there was a bit of rebound second half of last week, and then like, it did a retest of this breakdown around 170. So currently some pullback over there, some pullback happening. I think price probably find some support if it does a retest around this 147 to 150 this area where you have the 5 and 10 SME levels, and then this was also like a bit of consolidation area in the end of at the end of June. So yeah, probably it could do a retest and then do some sideways afterwards. Yeah, still currently probably still some slight resistance on the weekly 5 SMA as well, which is about $1.57. So I think that's some resistance in the short term as well. And next for UOB, yeah, UOB generally the banks have been very very strong, especially last week. So for now, I think yeah, just some in terms of the size of the candlestick getting smaller. So probably we could see some slight consolidation, but definitely still very strong. Short-term support probably I think it's 5 SMA level as well, which is currently about 43.60 about there, and then 43.50 there. We also have a horizontal support level here. So I would think for UOB for now, I think some sideways consolidation and then maybe another leg afterwards. Yeah, because I think for now it's like price is slightly above the outside of the Bollinger Band, so maybe some consolidation first, then it could go up again. Next one for DBS and ST Engineering. So for DBS, similar thing. Yeah, today we tested the 5 SMA level as well as the horizontal level here around about 69.80 and found support. So definitely still very strong. Yeah, so I think we could still see price try to trend along the 5 SMA level as a support to look at in the short term. Yeah. Next one for ST Engineering, I think nothing much to look at for now. Price has been sideways since March. So key area, look at Bollinger Bands. I think key resistance is still about close to 1120 about there. Support for now likely to be around like 1080. I think that probably could hold the price for now. Price is just been sideways start of this month about 1080. So I think nothing too much for now for ST. Okay, then moving on to some of the US counters. First one on IGV, the software, which is the software ETF. So for IGV, I think it's probably sideways right now. So some resistance currently is 95, this level, which was this horizontal level we see previously in May, as well as the breakdown level. And yeah, price is just consolidating sideways. I think the key support for now would likely be this swing low around $90.50 about there, which is also the 20 SMA level. So I think this needs to hold for the potential rebound here to continue. If not, we could see a reversion back downwards. So I think for now it's just a bit of a sideways between $90.50 to about 96 about there. then if price can subsequently can try to break over 96, then we could see a retest of 99 to 100 as next key level. So for IGV now, I think it's still pretty sideways. Next one for Microsoft, I think the chart wise is quite similar to IGV. So yeah, also pretty sideways. Pretty sideways for now. Just hanging around the 570 is like 384. Key resistance about like 398. Yeah, so in terms of daily chart, I think probably nothing too much as well. With resistance at this swing high 395 to 400 here, this next swing high level. And then I think price will be supported if it does a retest of the 373 to 380. So quite sideways range bound for now. Next one for Walmart price, I think last week there was a retest of the key hours uptrend support line. So this is at over here, and price did filled the gap over here at 113 and still holding steady. So I think for now, I think still probably some sideways open. I think could go a bit higher. If as long as it stands above 113. Next key reason is about 100 close to 116, this 20 SMA level, and then this was also a breakdown level. So about could test close to 116 as the next resistance, and support is about 111, 112 for now for Walmart. Okay, next one for Meta, which rallied quite a lot last week. So for Meta, in terms of the chart, I think the key resistance, there's this downwards resistance line. So if it does retest about 690, I think that's a very strong resistance coupled with this swing high. And currently, I think last Friday also tested this very strong horizontal level, is at 675. So over here, 670, I think to 690 will be quite a strong resistance zone in the near term. The price likely to pull back from. And then I think for now, with the sharp rally for past 2 days, we could see some pullback for price to reconnect with the 5 SMA level to provide some support. So I think for now, support probably could be around 640. 640 if it does retest this level over here, and then when it reconnects with the 5 SMA level of the strong rally. Next one for NVIDIA. For NVIDIA, I think share price looking a bit better price action last week. We can see that from Wednesday, there was a break out of this 200 level. So this was a key horizontal level. Price was trading the range under. Then another thing was that previously was under this 20 SMA level, and then Friday also managed to break above. So currently, I think support-wise, probably 205, 204, 205 over here would likely form some support. Resistance, I think, will still hold at this 210 to 214, this area over here with the swing high levels. Yeah, on the weekly chart is also like a retest over here. So probably, I think we'll do a sideways again, but at probably at a higher support level of about 204, 205. Next one that for Justco. Yeah, for Justco, I think chart-wise is looking a bit better. Last week, there was a potential higher low over here. If you look at the retracement, it was about, this is a 61.8% retracement level, just nice, about around the 54 cents level. Then Thursday, Friday, there was, Friday and today, there was quite a big rebound to retest this swing high 62 cents. So probably some resistance coming in. 62 cents for now is also the upper Bollinger Band. So probably some pullback. I think short-term support, I think, will probably be around this 57 cents where all the moving averages are around this level. And then this 57 cents is also like where this horizontal is also a key horizontal level. So I think price will probably find some support over here and then do some sideways again. Yeah. As long as if you can hold the 54 cents higher low, then I think will be more positive in the short term. Yeah, so I think now it's just after the pullback, since IPO is trying to do some sideways first to see whether the higher low can form. Okay, next one is on the Ping An and BYD SDRs. So for BYD SDR, I think overall still downtrend. Then we're seeing some rebound and sideways. So I think overall for 143 to about 146, which is still like quite a bit of resistance, and price is just sideways now with I think support is only around 136. And so I think we could expect some continued sideways for the time being. On the weekly time frame, also we can see the 140 and above is the 10 SME level weekly, which is likely some resistance as well. So I think it's just a rebound after quite a bit of downtrend. Then for the Ping An SDR insurance, I think Ping An insurance SDR, I think is nothing too much, just kind of sideways price holding support around the 420 is this level, and then with some reasons say this 443, and then next is 455. So it's just quite just sideways. The volume is also quite low as well. Okay, next one, move back to some of the Singapore names again. On Sembcorp. So I think Sembcorp, I think a familiar kind of signal has kind of appeared again. So for Sembcorp, we tend to see some sell downs previously. I think price for down will likely do some sideways. So the last time, if you look at the price action, kind of similar to the August sell down last year, then where there was high volume as well. Recently, there was also high volume. In terms of the daily RSI, we can see that hit about 23. 23 is quite a key level. So previously, it hit this level, and then there was a rebound afterwards. So previously, another time that it hit this level was somewhere close to like October 2024 was also pretty close over here. A sell down, and we see price sideways and rebound afterwards. I think it was 2022, another one as well, similarly sell down and then rebound. So I feel that for now, we can take probably some reference from the August price action, probably some sideways for now first, then I think we'll do a rebound afterwards. And so I think that's for Sembcorp. And next one on SingPost. And for SingPost, I think generally just a bit of slight rebound after a downtrend. I think key resistance could still come from this downtrend resistance line, which is testing now at 36.5 cents level. And then this coincides with the upper Bollinger Band as well. So probably could see some slight pullback. With support, I think for now is about 35 cents. This swing high as well as the 10 SMA. And price could do some sideways afterwards. Next one on Delphi. Now for Delphi, I think overall price action still quite sideways for now, but there's still likely some weakness from the pullback. So pullback from the highs, broke some key levels on the way 104 and recently 95 cents level. Retest found resistance, and for now it's holding the key support around the 87 to 80 cents area. Then resistance also at 92 cents, so quite range bound, but generally still forming lower highs. Yeah, so I think very important for these 87 cents to hold. If not, we could see some continued lower lows towards like 84 cents about there. So probably some still a bit sideways and towards the weaker side for now for Delphi. Yeah, then for Moneymax, overall, I think key support that needs to hold is around this 70 cents. So, yeah, price action wise, there could be a like potential head and shoulders. So, which is not very good. Then recently also broke down this support level 80 to 82 cents levels. Price is just sideways for now. I think probably nothing too much at the moment. With key resistance on the 70.5 cents level out there. So I think price will just do some sideways for now. But the key levels of hold is this 70, this recent swing low at 71 cents. If not, we could see further weakness. The next one on SIA. I think SIA some short-term weakness in terms of momentum. Before that, we can see price on daily time frame has been holding the 10 SMA level, the red line. And then there was a breakdown, I think last Wednesday, high volume as well. Also breakdown this 770 level as well. So finally, I think this will be a bit of resistance. Support wise, I think the whole is still this 20 SMA level. Also the horizontal level around 755. So this needs to hold to maintain this uptrend. If we break down this level, you could see some lower levels we test like 740. So probably some consolidation sideways for now. For Geo Energy, for Geo Energy, I think currently hit another resistance level, which is this 56 cents, this level, this previous breakdown level. On the Bollinger Band is also the upper Bollinger Band retest over here. And if I pull out the Fibonacci retracement levels, it's also the 50% mark. So I think here might pose a bit of resistance. I think price could do some pullback to retest this 5 SMA level. I think this will still hold as support at 54 cents. So I think we can see still a very slow recovery, I think, overall. Then price might do some sideways again, like what we saw over here this period. Yeah. Next one I'll take a few more. Micron. For Micron, I think some share price action weakness up. We can see the double top after the results. Then another confirmation is the breakdown of this our support line over here. And then last week there was a retest of this breakdown level at like 1030 that met resistance. So probably the next key support, this uptrend support line to hold is this level at 920s. So if this needs to hold, if not, we could see some further share price weakness to retest the 50 SMA level, which is this swing low as well, like 890. And then next support level will be like 850. So I think short term wise, we could still see some weakness. On the weekly time frame, also the retest of the weekly 10 SMA last week, 925. This needs to hold. If not, we could see some further weakness as well. And for Intel, for Intel, I think also has been pretty a bit weak in the short term with in the weekly time frame as we break down the 10 SMA weekly. So there's weakness. And then short term wise, I think support could still be this 10415 level, the lower Bollinger Band. So could see possibly see some sideways over here. Then resistance is for like 5 SMA onwards, so which is 113 to 116. I think this will be the resistance. So maybe some sideways. Below 105, the next key support is about 98 to 99. Yeah, then for Nebius, Nebius also last week we tested this swing low 200. There was a bit of rebound, but I think generally this 228, this 10 SMA level onwards to about 235, this area would be the resistance. And then I think price could do some sideways overall. If it breaks below this 210, then could we come back to retest a support in like 193 to 200. I think it's about 1 o'clock. I will hand back a time to Paul if you have anything to add on. Thanks.
Okay, let me just take this last one since with bankers selling at 76 to so-called stabilized but buying back at lower IPOs, it looks like profiteering from late retail piling in, remotely similar to concept of selling a short. Actually, it's not really pump and dump because they didn't really push. No one's pushing the share price up, so you can't not necessarily like a pump and dump situation. It's usually oversubscription, so people wanted to buy more at 76. They'll just allocate this pool. If the share price is above, they won't come in. It's actually helping the IPO price in a way because it's supporting the price to hopefully keep it above or at or above the IPO price. So in a way, it's actually more like helping the IPO rather than trying to so-called try to push it up and because they're not pushing it up above the 76 cents for foundation. Whether I'm not so sure whether any banker would want to have the IPO price below the market. Because I think nobody will want that situation. Nobody will want that situation. Yeah. Because if you have any IPO below IPO price, it's just going to hurt your next deal. Management also won't be happy. Nobody will be happy when the IPO is below IPO price. Yeah. It's just a mechanism to support the IPO if it goes below. If not, then it doesn't. Then nothing happens. Then the share price will just be oversubscribed. Yeah, I hope that all the IPOs are down. Yeah, so at least for the main board, I mean, it's no point based on that comments, based on that what Zane showed, virtually no point subscribing for the main board once, depending on the valuation and sector. But catalysts look interesting, especially the tech ones. If you can't get also maybe on those numbers that he showed, even buying on the first day could actually get some gains. Yeah, the first closing day, the closing price of the day, maybe not the intraday high or so forth. Yeah, thanks. Yeah, I hope that was helpful. I mean, just to give you some perspective on IPOs. Not everyone is different, so it's not you cannot like broad brush every single IPO. But just to give you some general comments on it. Hope it was helpful anyway. Yeah, thanks everyone. And hope to see you again next week and have a wonderful week ahead. Thank you, everybody. Bye bye.